Hello and good morning. Welcome to our webinar on pensions and divorce. Please do ask questions if you have any at any time. You can do this in the question box within the control panel you should see on the right hand side of your screen. The questions can only be seen by the moderator, so not everyone else is going to be looking at them. And at the end of the webinar, we'll answer as many of those as possible. There are quite a few people on today, so we might not get through all of them, but any questions we don't get to, we will respond to after the webinar. Also, if you do have any technical issues with the broadcast, please just report that in the question box. And I say our moderator will try and come back to you and help resolve those as soon as possible. There'll be an email sent out to you about an hour after the webinar asking you to fill out a feedback form. If you can fill that in, it would be greatly appreciated. It helps us iron out any issues and also help improve webinars that we can present and hopefully be of use to you in the future. We'll also issue a CPD certificate and a copy of the session slides issued via email at the end. And I should just say that this content is for professional advisor audience only. Okay, so we'll get started then looking at pensions and divorce. Now, first of all, I'm going to have a quick look through sort of the basic process of getting divorced and what that means in terms of pensions, what the options are. There's a couple of important dates around pensions, effective dates, implementation dates, and looking at the difference in those and what they mean, a few practical issues, the different kinds of pension credits that are available, and I'll finish off with looking at the implications for clients with protection when they get divorced. So looking at the divorce process, so the decree absolute is the final bit that legally ends a marriage or a civil partnership that's granted by the courts. That's normally the last stage. Before that, in England and Wales, you will normally get a court order in relation to the financial assets. Now, this can either be a consent order. This is basically when the two parties come to an agreement themselves and the court is just rubber stamping the agreement. When things aren't quite as harmonious, it may be that the court needs to decide things, and in that case you'd get a financial order, which is where the splitting of assets can be contested. So you'll have a court order of one form or the other in England and Wales. In Scotland, you can have a court order in a similar fashion, but you can also have a qualifying agreement within a formal minute of agreement as an option. Slightly more straightforward process that is available as an option in Scotland. It does still have to be registered in order for that to be enforceable. The other main difference for those of you north of the border, for divorces north of the border, is that when it comes to splitting of assets, then it's only assets that are considered in relation to the settlement of those that are acquired during the course of the relationship. So the marriage itself, and if they've been cohabiting previously. Now, there is actually a bill going through Parliament at the moment to try and change the law in England and Wales to match that, really to be a lot more similar to that in Scotland. That's the Divorce Financial Provision Bill, which does include clauses relating to pensions and pension sharing. It is only a members' bill. It has been going through for a while without getting very far. I think the government are probably a little bit busy with other things at the moment. But because it's a members' bill, it may never come to light, but you know, there are attempts being made to change the English way, the law in England and Wales, to give them the option of doing it similar to Scotland. If you have clients that get divorced overseas and they have an overseas sort of court order or equivalent, you can't apply that to a UK pension scheme. You have to get it in the courts over here, England or Scotland, in the courts here, in order for those to be applied to a pension scheme in the UK. So when it comes to pension schemes themselves, your sort of options on divorce of what you can do with them. Three main options: offsetting, earmarking and pension sharing orders. So offsetting was the only option prior to 1996, and this is simply where you offset the value of the pension scheme against other assets. Now, it would still be sort of your first port of call, really, your first option to look at doing this, because then you don't have to sort of mess with split or anything to the pension scheme. But obviously, in a lot of cases, when you have the pension scheme is like the biggest, could be the biggest or one of the bigger financial assets that the couple hold, that it's not always possible just to do offsetting. Now, offsetting traditionally wasn't done on a pound for pound basis, because money that's locked up in a pension scheme that couldn't be accessed for many years and maybe sort of limited in terms of how you access it would seem to have a lower value than money that you could access immediately. Now, that view is open to interpretation, and different circumstances will impact it, really, because especially in the light of pension freedoms, there's a big difference between somebody who's getting divorced at the age of 35, they've got 20 years before they can touch their pension scheme, or they might be in a DB scheme, they might be in a public sector scheme that can't be transferred, and those are all sort of, they really are locked up. Whereas somebody who's getting divorced at the age of 55 and they've got a DEC scheme which they can access all of the fund and the pension freedoms, then you could argue that should be treated more like cash, just less the any tax charge for deductions. So it is really sort of open to interpretation and big differences in the value when it comes to offsetting. So it's not always as straightforward as it might first appear. Earmarking was then introduced and came into force in 1996. This is a way of earmarking pension assets so that when the original member comes to take their benefits, a certain proportion of those benefits are paid to their ex-spouse. Now, there's lots of issues with this, really. First of all, it is only paid when the former spouse takes benefits, and the ex-spouse, who's the recipient of the benefit, has no control over the form or timing of those benefits. They don't control the investment decisions. Particularly in the light of pension freedoms, you may find that people never take benefits, the member may never take benefits, and so the ex-spouse never gets anything from the earmarking order. They can turn income on and off as they would like. With an earmarking order, it stops if the ex-spouse remarries, or if they die, there's no death benefits. That they would get anything they could pass on to their beneficiaries. It's certainly not a clean break, because they're tied together sort of indefinitely on this. For planning purposes, they have no idea how much money they're going to get or for how long they're going to get it, because say if the original member dies, then that's the end of it, even if they live for another 20 years. It's also taxed as the pension holder's income, so the original member could be a higher rate taxpayer. The ex-spouse might only be basic rate, but they still have a higher rate tax deducted before they receive their income. So really not great. The only advantage of an earmarking order these days that I can think of is if you have something where the divorce is fairly harmonious, and you had somebody who had a protected pension age, maybe an ex-sports star or something, and it would mean that their ex-spouse could also have access to the pension rights earlier. Whenever they choose to take their benefits, they would also get it. But aside from that, really struggling to think of why you would want to put an earmarking order in place these days. So pension sharing orders have come into place now, and this is by far the most common sort of way of sharing pensions, or opposed to earmarking these days, and that's really what we're going to be talking about for the rest of the session. So pension sharing orders were introduced, coming into force in December 2000. So yeah, earmarking orders were only sort of around on their own for sort of 4 years, but they realised it probably wasn't the best way of doing things. So pension sharing orders really does offer a clean break. So there's a pension debit for the original pension scheme member with a corresponding credit for the ex-spouse, which they can transfer those rights to a pension scheme of their choice. So it gives them their control then to make their own investments, to choose how they take their benefits. Now, it is a percentage of rights to be transferred, and that is the case in England, Wales, and you can have that in Scotland. But in Scotland, you have the option of having a monetary figure, and that option isn't available in England and Wales, so there is a difference there. Now, the pension credit can usually remain in the same scheme, or it can be transferred elsewhere. You can apply a pension sharing order to most types of pension schemes, so occupational, personal, retirement annuity contracts, Section 32s, can be for active deferred pensioner members. One sort of key exception is that you can't apply a pension sharing order to any beneficiaries' pensions. Now, historically speaking, that wouldn't have been an issue because you're not going to have very many people that would have been that had to be married, widowed, married again, and then divorced to actually have beneficiaries' rights. But of course, post-pension freedom, it's not just dependents that can be beneficiaries. We're going to see a lot more of people, particularly sort of children, who are going to be beneficiaries, adult children who inherit their pensions, the parents' pension pots, who may inherit them, you know, sort of maybe in their 30s or 40s quite easily, people that could potentially then go on to get divorced, and their beneficiaries' pension could be a large part of their pension savings. And it's just, yeah, worth bearing in mind those you cannot share those. So if you were taking those into account in the settlement, then offsetting would really be the only option for those. In terms of schemes offering internal transfers, usually most private sector DB schemes don't normally want to offer an internal transfer. They don't really want the ex-spouse to become a member of their scheme. They will normally look to have those transferred out. If you're in public sector DB schemes, though, the public sector schemes will always offer an internal transfer, so the ex-spouse can become a member of those schemes. Moving on to a few of the sort of different dates then in terms of the process, how it all works. We have what I'm calling the effective date, which is the date the court order comes into effect. But if you like reading legislation, it's actually called the transfer day, which personally I found very confusing because nothing ever gets transferred on the transfer day. So what the effective date means is that it's a date that's set in place that any contributions or transfers in that the member makes, anything that comes in after the effective date, those rights aren't shareable, so the ex-spouse won't get a part of those rights. But conversely, if the member takes any income or has a partial transfer out or anything after the effective date, that shouldn't reduce the shareable value for the ex-spouse. Now, the effective date will always be the later of either the decree absolute or 28 days after the pension sharing order is granted. Now, sometimes it's 21 days. It will always state it on the annex. It'll state whether it's 28 or 21 days. Normally, you get the decree absolute is the last bit that you get. But sometimes that may be less than 28 days after the pension sharing order. The effective date is a really important date if either of the parties die, because even if the member dies after the effective date but before any transfer has been made, so the pension credit hasn't been transferred to the ex-spouse, it is still effective. So that transfer would still be made after the death of the original member, and it would still go to the ex-spouse for them to have in their own pension rather than going to the original member's beneficiaries. So yeah, it's an important legal date in the process. When it comes to implementing the pension sharing order then, so actually, you know, we've got it from the courts, how do we actually put it in place, what you need to do? You need to send to the pension scheme administrator the pension sharing order itself and the annex that goes with it, and so that's the information that tells the administrator what the actual split is going to be, and it'll also have things in there about like who's going to pay the fees. Whether they're split proportionately or one party or the other is paying them, that'll be in there. You need to send in the decree absolute, so we know that they are finally divorced, or it'll be the registration of the qualifying agreement, potentially if you're in Scotland. And then the completed pension sharing discharge form. Now, this is just the provider's form, so it might be in a slightly different format depending on the provider. But basically, that is giving them the pension scheme, the information on the ex-spouse and the person who's not the member at the moment, their name, date of birth, address, and NI number, and where, crucially, where they want their pension credit paid to. Now, the pension scheme can't do anything till they have all that information. And we can see there are times when this can be delays of months and months, and even in some cases years. We might have the pension sharing order and decree absolute, but until we have the information from the ex-spouse as to where they want their pension credit share sending to, then it does kind of leave the pension scheme in limbo, which can create quite a few problems. From the ex-spouse's point of view, it's not ideal because the original member will still be making all the investment decisions on it, so they will still have all the control until the point that the funds are transferred out. But also from the member's point of view, it's not great because now the pension scheme is fully aware about the presence of a pension sharing order. They know this is going to be happening, that this is coming. They are within their rights to refuse partial transfers out and income payments, if there's a chance, but they could mean the pension scheme couldn't meet the pension sharing order and would have insufficient funds left to pay the pension credit. So it can have a knock-on effect for the member. So really, if you're dealing with the party who's receiving the pension credit, I would say, you need to be having those conversations as early as possible, sort of planning about, where you want the pension credit sending to. So as soon as possible, you can send that information to the pension scheme administrator and get it sort of dealt with as quickly as possible. Once the pension scheme administrator has all the information, then that starts the clock ticking on what is known as the implementation period. Now, regulations state that scheme administrators have 4 months from the date they receive all the relevant information, as per the previous slide. They have 4 months in order to make the transfer out. Now, within that 4-month window, we have a valuation date. Now, the scheme administrator is allowed to pick any date within that 4-month window. We, as an administrator, we always choose the first date, so the day we get all the paperwork in, that's what we use as a valuation date. But other providers might do it slightly differently. They're entitled to do that, say, as long as it's within the 4-month window. It's not the same as the effective date, so your value on your valuation date will be different from the value on the effective date. But the valuation date is the day where you go from have a percentage figure that's going to be transferred to actually having a monetary amount. So that's the only point, that's the first point in time where you're going to know exactly how much money is going to be transferred. But as I mentioned earlier, it may be slightly different in Scotland because you can put a monetary amount on it from outset. So I've mentioned there's a 4-month window to do it. However, in practical terms, Ombudsman rulings have shown that they actually expect the pension sharing order to be implemented as soon as possible. So there's a case a few years back, 2009, where a complaint was made despite the transfer being made within the 4-month window because it wasn't as fast as it could have been and there was still classed as unnecessary delay. But conversely, we've also had rulings where it's taken more than 4 months to make the transfer for practical reasons, but if the scheme administrator wasn't at fault, they cannot be held responsible. So really, it's a bit of an arbitrary 4-month window. Really, the scheme administrator just has to do it as soon as possible. So I've mentioned effective evaluation dates and that there can be differences between the two of them. So just a quick example to sort of run through how it works. We have a 50% pension sharing order with an effective date here of the 1st of June. At the point in time, the fund was valued at £500,000. If the member then on the following day withdraws 50,000, we then have a valuation date of 1st of August, at which point in time the fund values 455,000 because it's had a little bit of growth on it. when we come to look at the fund split and working out the monetary amount for the ex-spouse, what they're going to get, the effective date, I've put effective date fund split there, is really, I suppose, it's the effective date, how we apply that, taking into account the withdrawal by the member the following day. We have 50% of the fund value on the 1st of June is going to the ex-spouse as per the pension sharing order. And then we have, of the members, 50%, 40% of that is still in the pension scheme and the other 10% is withdrawn. So what it means is that they've withdrawn their income, they've taken that out from their 50%. So it's not having an impact on the ex-spouse on the pension sharing credit that they get. Obviously, if they've withdrawn it before the 1st of June, if they'd done it on the 31st of May, then that would have had an impact. So in this case, the pension sharing order at the valuation date, basically we take 50/90ths of the fund value at the valuation date, and that's the amount that the ex-spouse would get as a pension credit. It can, with pensions and divorce, it can be a bit of a moving target in terms of how much you're going to get. And as I say, this really does apply for England and Wales. As I mentioned, in Scotland, you can have a monetary value on it, but that's not the case in England and Wales. So here we have Brad and Angelina, who are getting divorced. The time then looking at doing the financial split, looking at all the figures, making the arrangements, Brad's slip is valued at £350,000. There's a bit of a gap, there's a few months before everything goes to the court and everything gets sorted. The pension sharing order is granted for 50% based on that initial valuation. We then have the decree absolute granted and an effective date, which in this case is 28 days after the pension sharing order. Everything gets sent off to the provider a few days later, and then we have the start of the implementation period, and in this case the provider has decided to make the valuation date the 20th of February, at which point in time the SIPP is valued at £290,000. So that is the monetary figure that's used. So the 50% pension sharing order is for £145,000, which goes to Angelina. Now, the point of this really is that at outset she thought she was going to get 175,000, and it actually turns out she only gets 145. There is always this issue that you do have a moving target with a percentage base, because you never know exactly what you're going to get. So I think it's important that clients are aware of that as part of the process, so it doesn't come as a big shock. But also, where as possible, is to use a valuation as close to the date of the pension sharing order itself, to try and minimise the risk and the movements in the market, and to try and get the value as close as possible to what should be used. A few other practical issues with pension sharing. This is probably the most obvious one, but it is one that we do see. A pension sharing order sent in to us saying, they want 50% pension sharing order to go to the ex-spouse, and they've got 90% of their SIP is in a commercial property. Obviously, it's very difficult to do that with illiquid assets. And really, if you have got illiquid investments, whether it's property or even just fixed term assets within the pension scheme, is to treat these the same as if they were not in a pension scheme, if they were external. If you didn't want to sell them, then or couldn't sell them, then you'd be looking at offsetting and other ways around dealing with those assets. And it's exactly the same as if it's in a pension scheme. There are limited circumstances where you may be able to force sale of assets, but it can be very difficult, especially where the member is a trustee, which is often the case in SIPs where there is a commercial property involved. The member will be a trustee as well, and it makes it a very, you don't want to get into that situation if you can at all avoid it. A lot of cases you might end up back in court, extra cost, takes a long time, and just draws out the whole process. So really want to avoid and just think ahead and try and deal with as much as possible. Another issue, it's an obvious point, but just a quick one, is if the member is in capped drawdown and they have a pension sharing order applied to their pension, obviously once it's after the effective date and once it's been transferred out, then they will have to have a capped drawdown review and have a reduced level of maximum income available from the following year. Moving on to qualifying and disqualifying credits, different types of credits that you can get with the pension sharing order. This is really if the original pension scheme member is in drawdown at the time of the pension sharing order, then the credit is what's called a disqualifying credit. And that means that the ex-spouse receiving the credit can't take any PCLS, any tax-free cash, or UFPLS payments from it. That's because the member obviously has already had their 25% tax-free cash from it, and you can't get 2 bites at the cherry. But on the positive side, it does mean it doesn't trigger the money purchase annual allowance, so that if an ex-spouse receives a disqualifying pension credit, wants to take income from it, they can do that, and it's not going to impact them being able to save, make pension savings contributions in their own right. It wouldn't have any impact. But when you're drawing up the arrangements, deciding the split of assets, obviously disqualifying credit is worth a bit less because you don't have the tax-free element on it. So correspondingly, where benefits are uncrystallised, then they are qualifying credits, and so normal benefits in the hands of the ex-spouse, so they still have the entitlement to PCLS and UFPLS in the usual way. Okay, moving on to protection issues then. First of all, I'm going to look at primary protection. So the member who has the pension sharing order applied to them has primary protection. Primary protection cannot be given up. You can't write to HMRC and say I don't want it anymore, but it can be reduced or lost. The member has a duty to inform HMRC if they have a pension debit, and then HMRC will give them a new certificate for the reduced primary protection that they hold after the divorce. If applicable, obviously there's nothing to issue if it's lost completely, and the reduction will apply from the effective date of the pension sharing order. So I've got an example just to run through sort of how this works. So we've got John here, and he had protection pension rights of £3 million at A-Day. And then he had a pension debit applied when he got divorced in 2010 for £300,000. What you do on this one is you deduct the amount of the pension debit from the A-Day rights, and then look at it as if you were applying for protection at A-Day all over again based on that new value. It makes no difference whether he got divorced, if you get divorced in May 2006 or if you get divorced in August 2018. It is just the monetary figure. So in John's case, the protected pension rights would now be based as if he had a £2.7 million fund at A-Day. And so his protection factor is reduced from previously he had twice the standard lifetime allowance, because lifetime allowance at A-Day is 1.5 million. So now he has 1.8 times the standard lifetime allowance, except for primary protection, the SLA is underpinned at 1.8 million. So this means that he now has 1.8 times 1.8 million as his personal lifetime allowance. So he goes from, so he now has, 3.24 million as his personal lifetime allowance. Just a point to note on this one, if people do lose their primary protection, it can be quite a nasty blow, if you like, because in this example, if his pension debit had been 1.6 million or more, that would bring his A-Day rights. If it was 1.6 million, it would bring his A-Day rights down to 1.4 million, which means he wouldn't have been eligible for protection in the first place. So he would lose his protection completely, and so his lifetime allowance now, he would just be on the standard lifetime allowance of £1,030,000. So even though his pension debit was 1.6 million, his protection would fall from his pre-divorce level of 3.6 million down to £1,030,000. So he loses nearly 2.6 million of protection due to a 1.6 million debit. And that is because he's not just using the factor, he's also losing the underpin, which of course is very valuable too. So if you do have clients, again, they're getting divorced in these situations, holding primary protection, you may want to consider, whether the pension debit can be of an amount that keeps them just above 1.5 million at A-Day and using offset other assets elsewhere to keep that valuable underpin. For members that have enhanced or fixed protection, those protections remain intact. There's no calculations, no reduction in those levels of protection they held, but obviously their pension savings have been reduced and they have very limited scope for rebuilding their entitlements, because any contributions they make, any benefit accrual in DB schemes are going to blow the protection. So depending on the amount of the pension debit, if it drops them below the standard lifetime allowance, then you might want to blow the protection and to build savings back up to the standard lifetime allowance. But yeah, so that will depend on different scenarios and individual clients. Individual protection then, similar to primary protection in that it can be reduced or lost. You have a duty to inform HMRC. They'll give you a new certificate or reference number as appropriate. The difference with individual protection and how it's treated on divorce and primary protection is the fact that the timing does make a difference. So if the transfer date or effective date is more than 12 months since the date of the protection, so that's either 6th of April 14 if you're looking at IP 14 or 6th of April 16 for IP 16, and the pension debit is reduced by 5% for each full tax year. So it's probably easiest to go through an example to explain what I mean by that. So we have Jeff here, whose funds were valued at 1.7 million at 5th of April 14, and therefore he holds IP 14, which was 1.5 million pounds. He then has a pension debit of £400,000 with the effective date of the 15th of June 2015. So because his protection, IP 14, is more than 12 months, because his divorce is more than 12 months after the date of protection, there is a 5% reduction on the amount that you deduct. So his reduction is now £380,000, so 95% of £400,000. So you deduct that figure from his fund value at 5th of April 14, and you base his protection on that. So in this case, his IP 14 will now be £1.32 million. Looking at it from the other point of view then, so this is the ex-spouse, the person receiving the pension credit. If they get a pension credit after A-Day where the pension was already in payment and came into payment after A-Day, they can apply for a pension credit. Basically, this means that the pension rights have already been tested against the lifetime allowance in the hands of the member before the divorce. So they don't, effectively, is to compensate for that, so they're not tested again, really. So they get a pension credit factor, and that is calculated as a fraction of the standard lifetime allowance at the time it's acquired. So an example here, keeping the math simple, I said £150,000 credit when the standard lifetime allowance was 1.5 million, then your credit factor is 0.1. Now the member, the ex-spouse who's wanting to get the pension credit factor and rely on it, they have to notify HMRC, and that's the form APSS 201 to do that. And they've got 5 years after the 31st of January following the tax year of pension sharing orders. So you've got quite a long time to do that in. And then HMRC will issue them with a certificate. In terms of an ex-spouse who already holds protection themselves, so if you've got wealthy clients who are getting divorced and maybe both parties hold protection, and so the ex-spouse getting the credit has protection of their own, enhanced or fixed protection is lost if that pension credit is transferred into a new arrangement, but you keep it if it goes to an existing arrangement. So if they've got a SIP or something, obviously you're going to have no problem already transferring that in, but you have potentially got an issue if they've only got for example, if they're a consultant NHS or something like that, that's not going to be able to accept a transfer in, they don't have any other arrangements, then the pension credit would, setting up a new arrangement to receive that, would blow their protection. So You're probably not going to come across many of these, but if you do, it's certainly one to be very aware of. Somebody with primary or individual protection, there's no direct impact on them receiving a pension credit, but obviously if their pension savings are now increased, it's maybe their level of protection won't cover all their pension savings. Okay, just to finish off with, I've put a couple of references on here which may be of interest to those of you that deal with a lot of divorce cases, or even if you just have the odd one. The first one is the Newfield Foundation have put together, they've brought together a pensions divorce working group, which is a lot of industry experts. They've put together a big document for consultation, which is effectively guidance notes for dealing with pensions on divorce, and there's a lot of useful information on there, sort of about valuing rights, sort of offsetting, you know, how you treat things, the practicalities, divorce. It's about sort of close to 100 pages. There's an awful lot of information in it, so it can be a useful reference document for you. And then the second one on family law, this is the report regarding offsetting, but it's valuing assets, so pension assets and other assets, and sort of how you evaluate the value of a pension, different circumstances, lots of different opinions and comments on there as well. So, you know, if you are looking at it, and you know, particularly it's not something you're not familiar with, is sort of how you value things for offsetting, both of those may be useful, restful reference documents for you. Okay, before I move on to questions, I'm just going to say that you'll receive an email in the next hour or so with a link to the online feedback form. If you could spare the time to complete this, it would be greatly appreciated to have your comments and help us sort of shape future sessions. So thank you for that. I'm just going to have a turn now and have a look at some of the questions that have come in. So have a little look through, just a moment. Had one of them's come in here, which I have seen this question asked before, about if an individual has a pension fund of say 2 million, can they divorce and in practice double their combined LTA through a pension sharing order and continue to live together? I have seen that one before, and in theory, yes, if the pension savings are effectively all in one person's name and the ex-spouse doesn't have any lifetime issues, that you could, in theory, they could get divorced and then they have pensions in their own rights and both have a separate LTA. It's probably a bit of an extreme solution to that issue, but theoretically possible. I'm not sure about sort of deliberately manipulating situations if there weren't other reasons for getting divorced, but in theory that may work. Can a pension sharing order be applied to a public sector scheme? Yes, it can. Yes, there's no issues with that, and public sector schemes will let the ex-spouse become a member of the scheme because they can't transfer out, so they wouldn't have any choice. But yes, they will accept an internal transfer, definitely, for a public sector. Whether it's in payment or not, yes, that's fine. Question here is, what happens if a fund reduces as a result of an existing member switching funds between a pension sharing order and a date of valuation? This is an important point with the effective date and the valuation dates. And again, it's the moving target syndrome that I sort of touched upon. That until it's been transferred out, yes, the existing member has control of the investments. So although sort of if they make a transfer out or take any benefits after the effective date, that shouldn't affect the share that the ex-spouse gets. But if they make investment decisions in such that reduce the value of the fund, then that will impact the ex-spouse. So that's another reason really to try and get your valuation date as close to your effective date as possible, to try and sort of minimise the loss, any potential loss there. I mean, it can be a bit unless it's a 100% pension sharing order, obviously if a member makes decisions that reduce the value of the pension, they will be impacting their own and reducing their own value as well. But I mean, 100% pension sharing orders do apply, so it is a bit of a difficult one. There are some sort of moral hazards in some of this, but yes, it would have an effect for the ex-spouse until they get control of it themselves. Let me just have a look through for the next one. Yes, there's a question here, it's a good one here. If there is still some tax-free cash available in drawdown, would this be split accordingly? Yes, normally if somebody is partially crystallised, unless it's stipulated otherwise in the pension sharing order, it would normally, if, for example, we received a pension sharing order and it just said 50% pension sharing order, and the member was partially crystallised, we would normally take it. It would normally be taken proportionately across the scheme, unless it'd been stipulated otherwise, which, if you're going to court and as part of the agreement, you could have it, and we just have to apply it as per the court order. But if it didn't stipulate it, then it would be just done proportionately. Somebody's asked about what's the position for a single life annuity and payment. Can the capital income be split? Yes, pension sharing orders can be applied to annuities too. So effectively, it would split the annuity between the member and the ex-spouse. The life company would do that accordingly. And again, somebody's asked about how does it work if a final salary scheme is already in payment? Yes, pension sharing orders can be applied to scheme pensions in payment. The split, if it was 50%, then the income would be applied 50% to each of them going forward. If it was, before benefits are taken, then there'll be an actuarial reduction for the existing member on that. But yes, it can be applied. Just have a little look through. Question here on with DB schemes with a pension sharing order. How's it viewed when the date of the pension sharing order and the date of transfer are quite far apart, and the cash equivalent transfer value have moved quite a lot, and it isn't quite what is intending? The answer is the pension sharing order is as per the order that's come from the court, the percentage, and yes, it may move, and that is sort of the point I was trying to make on the. Okay, I had a DC example, but it does apply equally to DB schemes, that you do have a moving target syndrome, and you can try and keep the valuation that you get from the pension scheme, whether it's a CETV from a final salary scheme or whether it's just a fund value on a DC scheme, and try and keep that as close to the pension sharing order date. And try and keep the process in as short a time frame as possible, wherever you can, to try and reduce that risk. But there is a risk there, and there will be fluctuating values, and there is a moving target. That it is an issue. One follow-up question here saying about when the DB scheme can be split in payment for both clients, does it get taxed at the member's rate of tax? With a pension sharing order, it becomes the ex-spouse's own pension, so it is in their own right, so it does get taxed at their rate of tax, their individual rate of tax. It is different from an earmarking order, which I touched on briefly at the start. With an earmarking order, that's when it's always taxed at the original member's rate of tax. but pension sharing order, because effectively it gets transferred. And with a DB scheme, certainly with a public sector DB scheme, where you can't transfer out, it would be an internal transfer within that DB scheme, but then it would become a pot in the the ex-spouse's own name, but they are taking the pension from them, so paying income tax at their own rate. There's a question here on any thoughts about planning before the divorce proceedings have started. I mean, a lot of it, I suppose, is going back to sort of the point about offsetting and how you value the assets and what you take into consideration. And with that one, I haven't sort of pretty much out of time. I haven't really got time to sort of go into that now, but I would say read that report from the Newfield Foundation, because there's got a lot of information in that one, on that one. I think we're about out of time now. So thank you very much. I will have a look through the questions. If you have sent a question that I've not answered, I will have a look through those and try to get back to you on that later on. But thank you.